Hi, and welcome to Alternative Angles. I'm Steve Rosen. I've been part of Fidelity's High Income and Alternatives division for going on 30 years, and I'm your host. A few weeks back, as I was looking forward to this episode on convertible bond arbitrage, I stopped into the Museum of Fine Arts here in Boston, where I saw some drawings by Hyman Bloom. For a time in the 1940s, Bloom was thought of as a trailblazing innovator, but then the critics cast him aside because his work was atypical and it was complex, and for a long time thereafter, Bloom was forgotten for the most part. But over the last number of years, he's received well-deserved attention and appreciation. I think of Bloom as an artistic analog to convertible arb. On the one hand, the strategy could be ignored because it's intricate and unconventional, and it takes some time to think through the details. But like Bloom's art, it turns out that convertible arb is an investment discipline that's well worth exploring. To shed light on the particulars, I spoke with Fidelity's Seth Gold and Bank of America's Michael Youngworth. Seth is Fidelity's convertible arb portfolio manager, and Michael is B of A's head of global convertible strategies. Seth and Michael are subject matter experts who explain an investment discipline that has moving parts, but it's also one that's well worth considering as a potential source of uncorrelated absolute return with low volatility. And now, my conversation with Seth Gold and Michael Youngworth. Seth, Michael, welcome to Alternative Angles. I'm looking forward to our discussion, and thanks for giving us your time.
It's great to be here today, Steve. Thank you for having us.
Thanks for hosting us, Steve.
Absolutely. So in preparation for this conversation, I refreshed myself on converts, which, to be honest, were not a core component of my investing career at Fidelity. And one of the things this recent research reminded me is that no kid has ever thought, hey, when I grow up, I want to be a convertible bond strategist or convertible bond arbitrageur. So tell me, what was the moment or the thing that led you to the space? Michael, let's start with you.
I really like that intro there, Steve. I've actually said that many times myself, that look back at myself, 15 years ago and said, wow, I really would love to get into convertible bonds one day. Never once has happened. So thanks for bringing that up.
Sure.
Yeah, no, I appreciate that intro. So, I got my start in high yield credit here within B of A Global Research. I've been at B of A now for just shy of 15 years. And I started in high yield back right out of school. And while I was working in high yield, there was sort of a carve out for convertible bonds. And this was, sort of the mid 2010s, 2012, 2013, around then. And converts were a relatively small sort of backwater asset class, I would say. And, it didn't dedicate, full research focus because of that. So, an opportunity to move into the asset class full-time opened in sort of, mid 2010s, 2015, 2016, around then. And I jumped at the opportunity given the space was beginning to grow quite a bit and get more eyeballs. And I've been in the seat ever since.
Great. Fantastic. And so now, Seth, maybe you could tell us about your path to the present and how you ended up here at Fidelity.
Yeah, I think the story kind of resonates because it's kind of one and the same. I was looking for a summer internship and knew I didn't want to be a lawyer or a doctor. And there was an alumni from my university days that happened to run a convertible desk at Jefferies at the time. And I had bothered him enough where he offered me 2 weeks on the desk, and it happened to be on the capital markets desk as well as on the sales and trading side. And that 2-week internship or shadow period turned into a career. I started my career at Jefferies structuring convertible bonds on the capital markets side. I then helped build the platform at Mizuho Securities USA, more on the sales and trading side, but also assisting on the capital markets effort. And then transitioned post-graduate school to the buy side, where I spent some time at a convertible-oriented shop on the West Coast before making my way back to the greater Boston area, where I've been for about the past 10 years. Investing and trading and managing convertible bonds, not only from an arbitrage side, which we're here to talk about today, but also from an outright side. So I think I bring a unique perspective to the convertible market, given that I've been a part of convertible bonds in pretty much all facets except for being the corporate issuer of a convertible bond. So it's been a full circle experience here. And I started my career as convertibles were cars, and that's the only thing I knew them as. And now convertibles are my life. And hopefully we obtain enough success in convertibles that I'm buying a car as a result of it.
Fantastic. Well, it sounds like you have quite a comprehensive background, and you too, Michael, as well. And so to set the stage, while we are going to talk about ARB, I think it's important to touch on convertible bonds themselves. So Michael, why don't you just start us off and just tell us what is a convertible bond and why do companies issue them?
Yeah, for sure. So a convertible bond is a hybrid debt instrument. It's basically a combination of two things. On one hand, you have your traditional corporate bond that would pay you back par at maturity and pay coupons, just like something you'd find in the IG or high yield space. And attached to it, sort of spliced right in, is a warrant, an equity warrant, which I think the easiest way to think about it is as a call option on the issuer's underlying shares. And this allows for participation with the issuer's equity on the upside, but it also allows you bond floor support on the downside. And what I mean by this is if the underlying stock rallies, the holder would likely opt to convert to shares. If it rallies through the strike price where that option is in the money, it would make sense to convert to shares. However, if it does not, if that does not occur, if the underlying stock declines or remains flat or just doesn't appreciate enough to make that option in the money, the holder has the option to get par back at maturity. So, the whole structure sort of looks like a call option if you were to sort of draw the hockey stick payout diagram. And this allows for convexity, which is really important. Typically, a convertible bond offers more participation with the underlying stock on the upside than you lose on the downside. So this asymmetric exposure is sort of the bread and butter for the CB investor. It's why the strategy often yields better risk-adjusted performance than equities and often straight fixed income as well. It also allows for additional carry over traditional stocks. So typically converts out yield, dividend yields on shares. Not only that, but it allows certain managers, arbitragers like Seth, to profit from stock vol, which I'm sure we'll talk about a little bit later. So I won't get into too much detail now. Yeah. From the issuer perspective, I would say the biggest advantage is cost advantage. Converts allow for a company to raise debt at a lower cost of capital than straight fixed income. The reason for this is because of that equity option. They're selling an option on their shares, so they don't have to compensate investors with much yield. In fact, we found that average coupon savings, even accounting for various derivative transactions that an issuer can overlay on their CB to make it less potentially dilutive to current shareholders. Even accounting for that it's called a capped call or a call spread. Even accounting for that call spread, the average coupon savings is around 1.5 percentage points. And this actually is even more important when borrowing costs are elevated, similar to today. We found that, in backdrops like today's financing, where spreads are really tight, but rates are kind of elevated, that coupon savings rises to about 2.5 percentage points on average. So really, really meaningful cost savings. Long story short, it allows issuers to sort of monetize their volatility. Higher vol yields better terms, more demand from investors, which ultimately yields better costs for the issuer.
Interesting. Okay, and Seth, maybe picking up on that, what type of companies are going to borrow in the convert market? What's the industry composition, and perhaps give us some perspective on how that may have changed through time.
Yeah, I think the heart of convertible issuance stems to go back to more of your growth type industries, your healthcare, your technology, your younger companies who are accessing the capital markets for the first time in their capital raise away from an IPO or a secondary offering that they've come to the market with. Kind of to piggyback on Michael's comments there, most convertible bonds are issued under 144A transaction, which allows them to be quick to market, low cost you don't require ratings to come along with this issuance typically. So most of them come unrated. And then beyond that, as we look beyond the growth topic of convertible issuance, it just depends on what's happening in the market conditions and what the market conditions are looking for from a capital raising perspective and from an allowance perspective. You have companies like we saw in 2024, where we see a lot of higher grade companies come to the convertible market, or you can go back to the COVID era where we saw the cruise lines come because it was a first resort financing when capital markets were a little questionable. You can go back to the global financial crisis where we saw names like Borg Warner come to the convertible market. And then more topical and recent, we've seen these big issuers like Boeing come to the convertible market as it's a way to shore up their balance sheet and ensure that they're financially solvent to continue operating. And so you have a variety of uses for a variety of different purposes. And that's just on the convertible bond side. I mean, we can go far beyond that and talk about mandatory convertible issuance. So there's really a variety of levers and pulleys that we can tap into here.
Okay, so there are a variety of issuers. There are also probably several types of different entities that invest in converts. You do it as an R, but maybe explain to us what the universe is that you're part of your sphere.
Yeah, so I think if you step back and think of it from a holistic perspective, there are 5 real players in the convertible marketplace, in my opinion. You have the corporate issuer being the first part. You have the sales and trading efforts from the banks that represent the facilitators in the marketplace. They help provide liquidity when needed, and they help match up buyers and sellers in the secondary marketplace, as well as bringing primary issuance to the marketplace. From the investor standpoint, you have your convertible arbitrage investors, similar to myself. You have outright investors or more fundamental investors who are buying a convertible bond because there's an attractive credit opportunity or equity fundamental lien that they have with regards to the issue. And then more what I like to kind of refer to as tourists or crossover players, which are your high yield investors who see a yield opportunity in a convertible security that's busted and that's attractive enough for them to come into the convertible space, or your equity income investors who find an attractive pickup relative to what they could get paid holding an equity from the dividend or yield that the convertible provides. And so they'll come and tap into the convertible market there as well.
I got to tell you, Seth, that in my investing career here, I think I would classify myself, per your definition, as more of a tourist looking for busted converts from time to time.
But the amazing thing is all of these players play an incredibly important role in the process. And that's what makes the over-the-counter convertible product continue to work. And in times of turbulence in the marketplace, this is the capital markets that tends to be the last to close and the first to open because there's such a variety of investors in the marketplace that people are willing to sharpen their pencils, do the work, and put the right valuation on a security to help a company in a time of need.
Interesting. So back to you, Michael. Given what we've just heard, what's the give us some context for the size of this market? There are a lot of players in it, but I know that it's not the largest. Can you give us some perspective on the size, the scale, and also what's the macro backdrop, or what are the market technicals that might lead it to either grow or shrink in your view?
Yeah, for sure. It's a great question. So, globally, it's probably a little bit shy of 400 billion at the moment. So it's certainly not, your largest market out there. Just for a little bit of context, the US high yield space is like 1.3 trillion, roughly 3 times the size of the convert space. But it's a really, unique market. So we might be small, but, I'd say we're sort of mighty in a sense. Regional breakdown, roughly 3/4 US, 2/3 to 3/4, roughly a quarter Europe, and the remaining, quarter to a third Asia, Japan. That has been shifting in recent years. Asia has risen as a portion of the space, and the US continues to rise as well. Whereas Europe has been declining and Japan has been declining as well. In fact, if you go back to sort of pre-global financial crisis era, Japan was actually the largest market in converts. So quite a bit has changed over time. In fact, the market was like half Japan, half US, and it's really shifted meaningfully. So US is firmly in the driver's seat. In terms of sectors, to Seth's point earlier, it's a lot of high growth. It's tech, it's high growth consumer, it's fintech. Lately, it's been more crypto names entering the space. It's biotech, it's pharma, it's internet, software. That is sort of your bread and butter converts issuer. But there are big pockets of utilities or real estate REITs stand out. We saw a lot of travel and leisure during the pandemic era. In terms of the types of investors, Seth also touched on it earlier, but I would say it's probably roughly around 2/3 hedge at the moment, 1/3 outright. That's a little bit of a shift compared to what we saw before the pandemic. Hedge funds have really risen pretty meaningfully in this space in light of the fact that there's been more opportunities to participate in new deals and profit from volatility, which again I'm sure we'll talk about in a little bit. In terms of potential growth next year, ultimately, we do expect the market to remain relatively flat on a total size basis in 2025. The reason being is, although we are expecting a very robust new issuance calendar, we're going to see a lot of redemptions next year as well. In fact, the maturity hurdle steps up quite meaningfully in 2025 and 2026. Most converts are a 5-year tenor when issued, and we saw really big pickups in issuance in 2019, 2020, and 2021. Right at the start of the pandemic. Seth touched on it earlier about how converts were the first market to open, and basically every cruise line, Carnival, Royal Caribbean, Norwegian, all the airlines, they all came to CBs right at the start of the pandemic to basically survive the lockdown. All of these names and a lot of other consumer names are beginning to roll off, now and next year. So we're going to see a lot of refinancings. But it does suggest while we might see a lot of issuance, a lot is going to come out on the back end as well. So we don't expect too much growth in the market size next year, but we don't expect contraction either.
Okay. So when I hear you say a smaller market, to me that could mean that there's some price inefficiency and opportunity, whether it's for an outright or an ARB. And so I thought that, with that as a backdrop, maybe we can now turn to convertible bond arbitrage. And Seth, I'll ask you, maybe you could just explain for us, what is it? And at a basic level, what are the key components of the strategy?
Yeah, so Steve, I love the question. Convertible arbitrage is a time-tested alternative investment strategy. It's been around as long as investing in convertible bonds themselves. And as we've kind of discussed earlier, it fits really well with all the players in the convertible marketplace. It's a relative value type of strategy and aims at capitalizing on pricing inefficiencies in the marketplace. And the most typical construct of a convertible bond investment is going long a convertible bond and shorting the underlying equity to neutralize or to pretty much zero beta the investment. But there's many other structures that we can talk about if we want to dive in a little bit deeper. There's so many ways of investing in convertible arbitrage, but the approach that we've kind of honed in on and really focused on is more of a diversified or broad approach, which means that at any given time we aim to hold a portfolio that's diversified not only across issuer or sector or issue size, but investment structure and where it fits in the convertible marketplace as well, allowing us to express our investment ideas and strategies in a variety of different ways. I think that kind of is best suited based on my background in the capital market space and in the outright investing space, and as a trader at heart originally in my career on the buy side. And it allows us to marry that with the fundamental analysis that's going on within Fidelity, and it allows us to facilitate this approach. We view convertible arbitrage as a strategic allocation for institutional investors who are looking for uncorrelated, capacity-constrained alpha generation. And we think that the product that we're putting in the marketplace really provides that. We believe that our ability to find opportunities in the market, regardless of the environment, is there. And why is that? We think really has been designed to achieve success in what we do. What makes convertible arbitrage as a diversifying strategy is probably the next leg in that conversation. And it shows diversifying properties relative to other alternative or traditional investments, because there's so many multi-dimensions that go into not only convertible bonds themselves, but how we structure convertible bond trades. Convertible arbitrage is at heart a long volatility strategy. And what that means is the more stocks move or the underlying stocks move, the more opportunity there is for us to generate alpha in the market. As we talked about a little bit earlier, the typical investment for convertible arbitrage is going long a convertible bond and shorting the underlying equity. We can do this a variety of different ways away from that typical strategy. And I think that's where I kind of get excited about convertible arbitrage. That's what gets me fired up in the morning when I come and sit down at my desk and look at the opportunity set that presents itself today in the market. One bond from another are completely different. I mean, there's different strikes, different options, different equity sensitivity, different credit stories. And we can marry all these theories together to find why one security is more attractive than the other. And I think that's what makes all the different convertible arbitrage investors slightly different. We all have slightly different views, and how we express those views are what make us unique.
Okay, so you're trying to identify a convertible bond with either mispriced credit risk or perhaps there's mispriced volatility expectations in the market, right? And so,
and then there's a variety of different ways that we can do it. So we can look at a busted convertible bond and something that's an attractive yield opportunity, and we can hedge out some potential credit risk that may exist in the future using the options market or using the stocks. We can look at more of a balanced convertible, something that's trading in the, let's call it 50 to 80 delta range. And there's a mispricing in the option there where we can buy a cheap option and we can trade the hedge that we establish in the security. And we can make money that way, or watch as the option appreciates in value and somebody else, an outright investor, may be looking to now take a different fundamental view on the underlying story. Or we can do something where a convertible bond is trading way in the money and it's an attractive opportunity for us to build a sizable position in the security. We have protection to the downside because it's trading more like an equity at that point. And we can hedge any of the equity sensitivity out of the convertible bond. It's a positive carry trade, or a trade where when you combine the coupon interest that you're receiving from the issuer, the rebate that you're receiving from shorting the underlying equity, and then you pay out the financing component for borrowing the capital to invest, the math still adds up and works. And it creates this protective put, or the synthetic put in the convertible bond, which if the stock were to correct significantly, the credit or bond floor component comes back into play, and you'll see some expansion in the convertible bond at that time.
Okay. Now, Seth, you used the word delta, and earlier Michael used the word convexity. I think many of our listeners are familiar, but some might not be. So, Michael, maybe you could give us just a brief definition of each, so
Absolutely.
we're all caught up to speed.
Yeah, that's a good point. Yeah, as a derivative product, there's a very colorful dictionary of language that we use in the CB space. Basically focused around the same option Greeks you'd find in the broader derivatives world. So delta is basically a measure of equity sensitivity. It's how much the convertible bond will move with respect to its underlying shares. So it's typically measured on a scale from 0 to 1 or 0 to 100, depending if you want to look at it as decimal points or percentages. But sort of anything that's 80 delta higher, we sort of consider that to be an equity like investment or an equity alternative. It trades a lot with the underlying shares. You have what's called a really narrow conversion premium, meaning that, long story short, it trades well above its bond support. So it's going to move a lot with the shares. If, for example, the underlying stock moved 10% on the upside with an 80 delta, you can expect the convert to move, 8% on the upside, in a single move. So that's, that's sort of how you define delta. Balanced delta, we sort of consider to be between 40 and 80 delta. This is where you have the best convexity. And to your point, Steve, convexity is is basically a measure of asymmetry, or sometimes we call it gamma in the convert space or the derivative space. It's basically the second derivative with respect to delta. It's how much that delta moves with respect to the underlying share price moves. So something that has a high gamma has a lot of convexity, meaning the delta moves around a lot. I hope that was somewhat clear. And then on the lower end, we have what's called your low delta names, your out of the money names, and these are names that have sort of a 0 to 40 delta. These are trading much more in line with the bond support than the equity value. They trade with what's called a really wide conversion premium, and these do not participate with the stocks all that much. This is where your busted converts fall. This is where your sort of out of the money CBs fall, because that option is so far out of the money, holders have no interest in converting to shares. And for that reason, it trades much more like a bond.
Okay, interesting.
And for anybody that's kind of stuck around at this point through all the crazy nomenclature and language that we live in, I think that the point that kind of resonates with me here and hits home as I'm listening to Michael explain all of this is what makes convertible investing barrier of entry exist. You can't buy a convertible bond by logging on to an electronic trading platform. These securities trade over the counter. So finding someone, the sell side, the Bank of Americas of the world, the JP Morgans of the world, the Morgan Stanleys or Goldman Sachs, you have to find someone that can facilitate the security to you and that can provide you liquidity in the security. And a lot of Michael's counterparts that we deal with on a day in and day out basis are actively making markets in these securities. And that's where the liquidity stems from, or the price that the market establishes and values the securities at.
Okay, now when you're putting on a trade, you're buying a convertible bond and you're shorting a stock and you're also shorting treasuries, right, to neutralize duration. So it seems like there's a lot of moving parts that have to come together in sync. And that sounds exciting in a thinking fast kind of way. But to execute that trade, there must be lots of advanced planning, thinking slow, which is your investment process. So Seth, how about if you describe to us that investment process that leads to trade implementation and the management of the convertible ARB portfolio?
The heart of investing, in my opinion, and this comes after years of covering some very talented and very smart people on the sell side, followed by years of working with some very talented and smart people at different places on the buy side, and then molding those views and those practices into my own kind of views and practices that I've put in place. And the one consistency that I think stands out in my mind when I think back over my career as to working with all these investment professionals is having a disciplined and repeatable investment process is first and foremost most important when you step into the marketplace on a daily basis. For me, it starts with idea generation, followed by analysis and structuring, followed by portfolio construction / risk management, and then being the ongoing portfolio management process or the day-to-day management or housekeeping of the portfolio. And being at Fidelity and doing this, the idea generation part is really cool and exciting. And I think that that's the first heartbeat of our unique process. We have a proprietary model here at Fidelity that we utilize. It screens the entire marketplace on a daily basis and assigns a value to each convertible security and the components that help drive that value, whether it's the volatility, the credit. And by doing that, it allows us to screen the market at a clear, concise way that's repeatable and removes any biases that we necessarily could have in how we're looking at things. The analysis and structuring part is fun. That's where being at Fidelity is another big advantage. You have the fundamental research that you can marry with our quantitative analysis that we put through. And we find unique opportunities, whether it's that we see a theoretically cheap security in the marketplace that we want to take advantage of a mispricing, or we find something that's closer to fair value, but we have an equity or credit analyst that we've partnered with that we look at something and we see a unique event or opportunity that may exist because of something that's happening in the marketplace specific to that company. And then building and constructing a portfolio that's really where the fun comes in. We like to build a diversified portfolio here, as we kind of talked about earlier in the story. And a diversified portfolio is a variety of things. We might find a small, unique deal that's really attractive and it's a great opportunity, but there might be hurdles that come along with that small, unique deal, whether it's liquidity constraints or overexposure to the size of the transaction. And so building a portfolio that kind of leads us into our next topic of risk management that's diversified, that is spread out among sector exposure, that's spread out among issuer exposure, that's spread out among liquidity exposure, are all things that are extremely important. And then specific to convertible arbitrage is spread out among the type of trade exposure too. It's really easy if you wanted to go and build a portfolio of credit sensitive names or really in the money or synthetic put names in the convertible marketplace. But having a differentiated portfolio that has exposure to, well, if the market as a whole continues, the equity market as a whole continues to grind higher, these are the names that are probably going to benefit the portfolio, but that's not the only way that you can make money in this portfolio. It is part of the fun of structuring that diversified strategy that we talk about. From a risk management perspective, being at a big firm like Fidelity, risk is certainly something that we're keen on and something that we're monitoring on a daily basis. We have a great risk team here that's constantly monitoring and shocking the portfolio to make sure that we're not overexposed in one name or one sector or one type of security. But what happens in those moments of, let's say, a March of 2020 where COVID comes into the marketplace and you see a drastic drawdown in equities, or a global financial crisis situation where maybe it's a little bit longer drawn, and what the impact of that may look like and how we're going to manage through that, and how we can talk to prospective clients and current clients as to this is what we anticipate to see. And these are the situations of the past, and this is how it would have responded, or this is how we think future unexpected volatility events might cause maybe a little bit of gapping or mispricing in the marketplace, and how we anticipate to respond to those events. And then the ongoing portfolio management is the day-to-day, and that's where we partner really close with our trading team. We have a great group of traders here that do a wonderful job not only accessing liquidity in the marketplace, but helping us monitor the day-to-day movement in the market, making sure that we have the exposure in every given security that we're looking to have, and that we're not exposed in places that we're trying to hedge risks out in. Making sure that our deltas and that our rate exposures are appropriate, making sure that our currency risks may be hedged appropriately. These are just kind of the ongoing portfolio maintenance, is kind of how I like to call it, and making sure that we're staying on top of that.
Interesting. And so there's a lot of modeling, pretty sophisticated. You also touched on, though, some of the resources that you have here. And I think it seems to me that from a fundamental point of view, that's particularly important, given that many of the issuers in the convert market might not have other traded debt. They might not have a credit rating per se. And so you have to do your own fundamental research, because part of your win is finding mispriced credits, right?
Of course. And
Yeah.
I think it's never more prevalent than it is as we sit here today. Credit spreads are at all-time tights right now. And if you probably asked Michael or myself, and I'm interested to throw the question back at you, Michael,
Sure.
it is probably the number one topic on my mind.
That's a good point. How much more can we feasibly tighten from here? So absolutely, Seth, I agree with that. I would highlight a few other risks. Number one, market concentration. And this is something that the CB space has seen before in the past. Given how on the forefront of topical themes the converts market is, we have a tendency to maybe get a little overexcited about certain topics, whether it's internet names or consumer or electric vehicles. And I am beginning to get a little concerned about market concentration here, where these names end up driving top line performance. Maybe not so much a concern for arb shops who are able to eliminate various risks and pick and choose and actually pull out the exposures that they want. But from an outright perspective, this becomes particularly challenging. Finally, one other point I would add here on risks is the potential for hedge fund deleveraging. We've seen a really big pickup in the convertible arbitrage component of the market in the past year and a half, 2 years or so. I think I mentioned it earlier, but we'd estimate about 2/3 to 3/4 of the market is now hedge funds, and a lot of these are pod shops or multi-strats, which they have the ability to move around. And if for whatever reason opportunities in the CB ARB space were to dwindle, again, this is not our base case, but just throwing out the hypothetical, they could exit the space relatively quickly, just as quickly as they entered, which could be a drag on the market.
I think that there's certainly some level of validity to that statement. I think, though, as we look at the convertible market today and what we expect to continue to see coming down the pipe in 2025, I would tell you the risk is much more so that we continue to see richening because of additional players coming to the convertible market on the arbitrage side than parties leaving the game right now. I think that as we look in the first quarter of 25, there's certainly a demand for convertible arbitrage at a lot of new shops or existing shops who are looking to further expand their capabilities.
Yeah,
and I think
agreed.
assets continue to flow into that strategy right now.
Yeah, agreed, for sure. We continue to see growth there. Absolutely.
And I think that stems further into the 2025 story as we look post the election and everything that's coming down the pipe. And we think about how potentially the Russell has been left behind a little bit, and more of your growth stocks haven't participated in the magnificent 12 turned magnificent 7 turned magnificent, I think, 6 as we sit here today. The Trump administration is ahead of us. And I think that kind of gives us a little bit more clarity, and we like clarity as investors. We like a good direction as to where we're going, and I wouldn't be surprised to see some growth. I wouldn't be surprised to see some M&A activity on the back of that. Some names that have kind of gotten left behind in the marketplace, that their valuations are just too cheap or mispriced right now from an equity perspective. And even if rates stay where they are, just looking at the credit market with spreads as tight as they are, stocks as high as they are for some other companies, to come and raise capital in the convertible space and then use that capital to buy some of these mispriced assets in the market, I think that there's primed opportunities for converts to continue to take off and be successful as we move forward.
Yeah, and I would imagine that, given that you're employing a strategy that is, seeking low volatility and an absolute return, you presumably would be able to continue to execute upon that in the future.
Yeah, I mean that's the hope in all market conditions, and that's why we do convertible arbitrage.
Exactly.
It isn't a strategy that succeeds in one market condition or another. It is more of a all-weather strategy. It's an uncorrelated answer. It's not the end-all be-all answer as an investor's portfolio, but it certainly fits in as a piece. And that's why you've seen a lot of these pod shops or multi-manager shops, a lot of these multi-strat funds come and utilize convertible arbitrage, because while there's different ways of looking at convertible arbitrage depending on the time frame that you're looking at, it certainly makes sense. I mean, if you go back to pre-global financial crisis and look at how convertible arbitrage was utilized relative to how it's utilized today, it's a very different story. It was a much more levered product before the global financial crisis. It was much more of a standalone or pure play strategy. It wasn't mixed in with the multi-strat nature that you see a lot of it utilizing today. But I think as a standalone strategy like we manage here at Fidelity, it gives investors further clarity as to what it is that they own, and they control how they're invested in convertible arbitrage as opposed to someone else controlling that for them.
So it sounds like that's what you view as the advantage of your strategy, in addition to what really buttresses it with its the models that you have that are proprietary and very sophisticated and have so far, I think, proven to be pretty durable, as well as the fundamental research that backs up the credit story.
Yeah, it just creates a really nice place setting for us to run this as a bellwether all market condition strategy. It's not something that changes in the marketplace would spook us from this strategy or advise clients to move away from this strategy.
Gotcha. Okay. What are there any changes that you guys see on the horizon?
We've seen a lot of optimism around the red sweep and the Trump win. And, this stems from the fact that the majority of CBs are higher growth, they're smaller cap names. And, these domestically oriented companies are generally viewed as bigger beneficiaries of some of the, so-called America First policies that Trump plans to implement. Of course, how much he gets done, when he gets it done, there's a lot of unknowns. We have noted in our year ahead outlook that our conviction around directional performance is not very high this year. What is certainly high is our conviction around volatility, which I think lends itself quite well to CBR in particular, which is great. In terms of other potential changes, we continue to expect the U.S. and Asia to grow at the expense of Europe. We've seen outflows from European funds. We've seen much fewer new deals in the European space. A lot of this has to do with the fact that there's a lower vol in that market, making it less appealing for a lot of the arbitrageurs. Asia growth driven by the high concentration of tech and high vol type names, which are much more appealing to arbitrageurs. We expect that trend to persist. We expect more growth in mandatory convertibles, and I don't think we've touched on mandatories in particular yet, and I guess I can give a brief definition, but mandatories are effectively a flavor of convert that requires the holder to convert to shares at maturity rather than have the option to get par back. So you lose your optionality.
So you really have to like the stock, right?
Exactly. You have to like this. If you don't like the stock, you're not going to like the mandatory. Exactly. The sort of benefit here is you typically have higher yield. They typically pay a higher distribution than traditional converts. There's, from the issuer perspective, there's a big advantage in mandatories, and it's equity credit. Rating agencies basically treat them like pure equity if the tenor is short enough, typically 3 years. So companies can use these to lever up for M&A or to protect their balance sheet. Seth, you mentioned Boeing earlier. They did a mandatory earlier this year, a really large mandatory in an effort to protect their credit rating, basically. Given that broader strategists, they're quite bullish on M&A. It does suggest that we could see more mandatory convertible bond issuance, which would be great for the space because it generally brings in, blue chip type names, large cap names. Boeing's a great example, a household name, and the CB space can really benefit from that.
Yeah, and then Michael, you had kind of touched on it a little bit earlier in your comments that the refinancing wall and the debt maturities that are coming here in 25 and 26. And if you want to take one step further beyond that, if you think about the high yield issuance that came during COVID and just coming out of COVID, I think a lot of those companies will probably look to pre-fund or refinance the debt that are coming down their balance sheets. If you look at the market where it is today and where rates are today and the interest expense savings potentially that convertibles offer these corporate clients, I think convertibles remain ever present and prevalent in boardroom conversations. I think that there's historically been a fear of bringing a convertible as a CFO, and I think CFOs are more sophisticated today than they've ever been as we talk to management teams, whether they have convertibles already on their balance sheet or considering them as part of their next capital raise. And then getting back to the interest expense savings component, I mean, Wayfair had been a staple within the convertible marketplace. And you look at what they did, bringing a straight debt, high yield piece of paper to the market this year at 7.25% relative to where they probably could have brought a convertible bond. And there's probably at least 300 to 400 basis points savings of interest expense had they come. Now, granted, Wayfair was coming for a different reason. They wanted a rating on the company. They wanted to broaden their investor base. And I respect that as an investor. I think that that's an important part of their strategy as they continue to grow beyond the growth story that they had kind of been lumped in as for quite some time. But I think that you're going to see a lot of higher grade companies come back to the convertible marketplace if interest rates remain where they are at these elevated rates.
Hey, I just wanted to come back to something that each of you said. Seth, you had just talked about the early refis of converts that are coming due, and just explain to our listeners how that can be an additional source of return because there's some call protection, right?
Yeah, it's a combination of the call protection potentially, or the make whole that the company would have to pay out as a part of a maturity or an early call of the security. But I think it's also part of the story of companies don't like debt coming current on their balance sheet. And I think that there's a big negative connotation that comes along with that. The last thing a CEO or CFO or an investor relations professional want is a phone call from an equity investor starting to question how they're thinking about their balance sheet and what are they going to do to shore that up. And so the proactive nature of refinancing or pre-funding has become very topical over the past, call it 18 months. And it's certainly been a trade that's been chased a lot in the convertible space. I think that you have to be cautious as an investor buying these securities strictly for refinancing purposes, making sure that you're at the top of the holders list is ever prevalent in that strategy, because it's easily left behind you're easily left behind if in fact you're not one of the investors that have a seat at the table. I think that certainly gets us excited as Fidelity and having the name and the brand that we have behind us. We have an outright strategy that's managing convertible bonds. We have the convertible arbitrage strategy managing convertible bonds. And then we have the equity component as well. So it does afford us an opportunity to get a seat at the table in most of those conversations. But as an investor, is something that I think certainly can't be overlooked as you're taking that strategy on.
Okay. So it's sort of some dessert that you might come into, but it's not something that you're necessarily counting on when you set up your trades.
Yeah, I think the trade has also evolved over the past 18 months. I think that if you would go back to the end of 2023 and look at the refinancing trades that were happening in the convertible space, companies were paying multiple points to take their convertible bonds out. They were paying a premium beyond where they were trading in the marketplace by multiple points. If you look at the trade that's happening today in the refinancing space, it's far less premium that companies are willing to pay. And I think part of that comes along with where these bonds are trading in the marketplace. It's evolved, and executives and companies are certainly getting smarter in this process and more disciplined as to how they approach this process. But it still remains ever present.
Before we wrap up, I just wanted to come back to something, Michael, that you said. You were talking a few minutes ago about the prospect for more volatility, which is favorable for a convertible arb strategy. Effectively, you're tending to buy low and sell high. Could you walk us through a little bit about how that works? Give us a little more granularity.
Yeah, of course, absolutely. Yeah, so this goes back to how convert arb trades are set up. They're set up in a way that's called dollar neutral. So basically, you are long the CB, you're short the stock, and you're short enough shares of the stock that completely offsets your position. So theoretically, you don't care which direction the underlying moves. If the stock gains, you lose on your short, your short share position, and you gain on your CB position, and vice versa. In the opposite scenario. But that is not static. The amount of shares that you need to be long or short, typically short, will change depending on how the underlying stock moves. So this goes back to our conversation about delta earlier. So as that underlying stock rises, typically the delta will pick up. And as it declines, the delta declines. And if the delta rises enough, you need to sell more shares to maintain your delta neutral position. So basically, you're making money on your hedge. So theoretical position, you're long the CB, you're short the shares. The underlying stock rallies. You sell shares now to maintain that delta neutral position at the end of the day. So you're effectively selling stock high. And then say the next day the shares decline. Now, in order to maintain that delta neutral position, you need to buy shares. So you're buying it low, and the more volatility you have, the more frequently that you need to rebalance that hedge, the more gain you're locking in. So this is why we say that Convert R benefits from volatility, and this is why high vol stocks generally price quite well in the CB space, while there's a lot of demand for high vol stocks.
Interesting. Okay, great. Well, I've really enjoyed this conversation, and to conclude, I'm reminded that there used to be this late night TV show that would have man on the street interviews, and the interviewer would offer the respondent either a hot towel or a baked potato to thank them for their participation. I have neither with me, but it has inspired me to come up with a parting gift. So I have in process, and soon enough, I hope you'll each receive an Alternative Angles logoed coffee mug for being such great guests.
Oh, wow.
And
great.
A keepsake that I'm sure you'll treasure.
I look forward to displaying it proudly on my desk.
Great.
Thanks so much,
Jack.
Steve.
I really appreciate the time.
Thank you, Steve.
Appreciate it. Thank you.
Thank you, Michael.
This podcast is intended for institutional investor and investment professional use only. Unless otherwise expressly disclosed to you in writing, the information provided in this material is for educational purposes only. Any viewpoints expressed by Fidelity are not intended to be used as a primary basis for your investment decisions and are based on facts and circumstances at the point in time they are made and are not particular to you. Accordingly, nothing in this material constitutes impartial investment advice or advice in a fiduciary capacity as defined or under the Employee Retirement Income Security Act of 1974 or the Internal Revenue Code of 1986, both as amended. Fidelity and its representatives may have a conflict of interest in the products or services mentioned in this material because they have a financial interest in the products or services and may receive compensation, directly or indirectly, in connection with the management, distribution, and / or servicing of these products or services, including Fidelity funds, certain third-party funds and products, and certain investment services. Before making any investment decisions, you should take into account all of the particular facts and circumstances of your or your client's individual situation and reach out to an investment professional if applicable. Fidelity and its representatives may have a conflict of interest in the products or services mentioned in these materials because they have a financial interest in them and receive compensation, directly or indirectly, in connection with the management, distribution, and / or servicing of these products or services, including Fidelity funds, certain third-party funds and products, and certain investment services. Alternative investments are investment products other than the traditional investments of stocks, bond, mutual funds, or ETFs. Examples of alternative investments are limited partnerships, limited liability companies, hedge funds, private equity, private debt, commodities, real estate, and promissory notes. Some of the risks associated with alternative investments are: alternative investments may be relatively illiquid. It may be difficult to determine the current market value of the asset. There may be limited historical risk and return data. A high degree of investment analysis may be required before buying. Cost of purchase and sale may be relatively high. Views expressed are as of February 2025 and may change based on market and other conditions. Unless otherwise noted, the opinions provided are those of the speakers and not necessarily those of Fidelity Investments or its affiliates. Fidelity does not assume any duty to update any of the information. Some of this information is forward-looking and is subject to change. Past performance is no guarantee of future results. Investment results cannot be predicted or projected. Information provided herein is for informational purposes only and is not a recommendation or an offer or solicitation to buy or sell any security or for any investment advisory service. Fidelity Investments and Bank of America are not affiliated. Fidelity Investments provides investment products through Fidelity Distributors Company LLC and clearing, custody, or other brokerage services through National Financial Services LLC or Fidelity Brokerage Services LLC, members NYSE, SIPC. C. 2024 FMR LLC. All rights reserved.